Introduction to Agriculture Finance. Finance in agriculture is as important as development in technologies. Increase in technology equals increase in funds or credit requirement. Before 1935, the financing was done by moneylenders. RBI Act 1934 bought lot of charges with District Central Cooperative Bank DCCB and Land Development Banks LDB. What is agriculture finance? The term agriculture finance defines agriculture finance as an economic study of borrowing funds by farmers, the organization and operation of farm lending agencies and of society interests in credit of agriculture. Lending, whether to a farmer or to an agribusiness, share similarities with lending to other sector, but due to the nature of agriculture also have some significant differences. Banks and lenders need to understand these differences so they can design their products, monitoring, credit, risk assessment, and repayment process. A bank needs to consider 5 C's when lending for agriculture finance: character, capacity, capital, collateral, and condition. However, there are also other essential factors to consider. As agriculture deals with nature, this may affect a client's ability to repay loan. These agriculture specific factors need to be taken into account when assessing client ability to repay, when sanctioning the loan, and when monitoring the loan throughout the season. Price into production equals revenue. It is critical that bankers, when determining whether to lend to an agriculture client, be aware that cash flows are linked to the agriculture production cycle. That agriculture cycle vary throughout the season. The variety of natural issues affect production yield. Weather effects, including outbreaks of pest and disease. This means the bank needs to structure product to meet the production cycle of the agriculture activity being financed. Understand in depth the value chain of the crop being financed, so as to identify where the major risks are and how they are being managed, including price risk, how contracts are priced and the impact this has on a borrower; yield risk, the variability of the yields and whether yields are being effectively managed. So they use some good agriculture practices or insurance and develop a monitoring system to identify issues early on so that prompt correct action can be taken. This may involve contacting agriculture expert to warn as impending issues. Lending to agriculture can be a great business, but it requires bank to understand the intricacies of agriculture and to develop appropriate procedures and products. This will ensure that lending is undertaken in the way that effectively takes into account of agriculture specific risk for the good of everyone. Significance of agriculture finance. Agriculture finance assumes vital and significant importance in the agro-socio-economic development of the country both at macro and micro level. It plays a catalytic role in strengthening the farm business and augmenting the productivity of scarce resources. Use of new technological inputs purchased through farm finance helps to increase the agricultural productivity. Aggression too in farm assets and farm supporting infrastructure provided by large scale financial investment activities result in increased farm income levels leading to increased standard of living of rural masses.